Three dumb ways to use options. As most of you know at this point, options are pretty awesome. You can make a lot of money with them. They add a lot of complexity, so there's a lot of ways to mess things up. So in order to not mess things up, if we understand mistakes, we can try to avoid them. So let's talk about these three dumb ways to use options and how you can approach it smarter. The very first one that I want to talk about is buying zero DTE options. Now, the example that we're going to look at today is in SPX. However, this really isn't relegated to SPX. What I have here for you is a breakdown of calls and puts. This is a little small. Don't worry about it. There's a graph that I want to show you more importantly. But these are your calls up top. These are your puts down at the bottom. You'll see that we go from 0.633, a first time hack. Why then instead of right after the open? Just to let liquidity come through. However, there is an important change that happens a few minutes after the open that this obviously will miss. So it's even a little more favorable. Then the next time hack is at 10. Then the last is at 12.55 right before the close. And then I just repeat that process for the put side of the equation. What I did is I started with slightly out of the money strikes. So I did a 39 delta call and a 35 delta put. And then I just looked at them at those different time frames. And what's one of the most important things we notice from this equation is this here. So the blue line represents your premium. The red line represents your delta. The yellow line represents your gamma. So what is going on here? Very, very simple. You are experiencing a massive amount of charm, which is, if you're used to reviewing some of my more in-depth videos on the Greeks, you'll know exactly what this is. That's delta decay. How fast does delta erode? Why does this matter? Well, if you buy these options soon after the open here, and then some time passes, your delta is now lower, even if the underlying isn't necessarily moving that much. Why does that matter? Because now you need an even bigger move in your favor in order to even get back to break even. Why does that become difficult? Because as your delta is decaying here, you also have gamma, which isn't really helping you that much. Gamma is not expanding enough to compensate for this drop in delta. So buying zero DTE options by itself, it can work. And if you're trading at some like very specific instances, fine. But for those that think that this is like a cheaper way to play things, it's a really cheap way to light your money on fire. Let's talk about the next stupid way. Being okay with assignment. Now, this is not relegated to selling calls or selling puts. It's really for all of them. Even if you're selling things like vertical spreads, because at the end of the day, assignment, especially for American style options that occur at any point, can happen, even if you have something like a vertical spread on. So what ends up happening here is traders will notoriously convince themselves like, oh, I'm okay with assignment. I would love the stock down here. This is what I call Goldilocks analysis. The problem with this is we're looking at and overemphasizing the good side of what might happen in terms of possibilities. The downside is we're not taking a practical look at how we might actually react if a worse scenario unfolds. So in the example of a put, let's say that we're selling a ton of puts because we like SMCI, we think it's going to go up. And we're selling puts, really high probability trades. It's all good. Then it starts to drop and we say, oh, I would love assignment here at whatever price, just 10 points lower than where it is. You start taking assignment. But then it starts going lower and lower and lower to the point where you can't even now sell calls. Well, your original game plan was to manage the downside by selling calls after being assigned. Meanwhile, in order to sell calls at anything at or above your basis, you're not collecting anything anymore. That's Goldilocks analysis. So again, it's completely okay to be okay with assignment if you actually think it through and actually are okay with assignment. Most people are applying superficial analysis and they're not actually okay with it. Same thing for the call side of the equation. We sell calls to collect some income as part of our long equity, which I hate that term in this context. It's just to collect some premium against our long shares. Nothing wrong with that. But the problem in this case is this trader, they have 100 shares of a stock and they don't want assignment. They don't want the shares to be called away. Well, you have to plan for this. And now they're trying to figure out after the trade is on, after these are underwater, how to manage this. Now, for those that don't know, a really slick way to manage this kind of thing is literally to just trade ratio covered calls. So what that means is instead of just stopping at 100 shares, we accumulate more, maybe 150, 200, 300, and then we sell calls against it to not cap our upside profit potential and to maintain some shares. I have a video that talks about that. Third and final thing, this is probably the most important one that I think just about everybody will have fallen prey to. Disregarding the impact of volatility. So let's use an example for this. Let's say that we're coming into earnings in Palantir and you want to trade the expected post-earnings move. So right now we're pretending it's the 4th of August. You don't know that it's going to gap up the next day, but you see a bunch of call activity and you want to buy some calls to trade this to the upside. Cool. So what's the downside to this? If you don't plan it very carefully, you can get absolutely ran over even though you're directionally correct. So let's take a look at an example here. I went to 4 August when Palantir was at 160. I traded an 11 DTE trade. Why 11 days to expiration? Because I was picking something that didn't include earnings that exposed me to the earnings move, but not overemphasizing the change in vol, because as a trader, an options trader, we know that vol collapses after earnings. So this is a trader that thinks they're counteracting that effect. But let's see what happens. This trade, they have about a 10 delta options. They have 10 delta options. Premium's about 99 cents, so about $1. That puts them out at the 200. So they're picking something that they're trying to compound with. It is going to be a little bit more of a convexity play. It does have elevated theta because it's pretty close in time, but this trader isn't planning on holding it for that long. And the implied volatility for this call is 87.15%. So let's take a look at what happens 24 hours later. Well, if we have a scenario that the stock did what we want, in this case, it jumped from 160 to 171, it's about 11.5 point change. So it's a 7% change in price overnight. 1 day has passed, so we haven't lost an exceeding amount of theta, but we definitely will have lost about 17 cents or so. But let's take a look at what happened to our Greeks. It went 11 points in our favor, yet our premium collapsed by 65%. Our delta collapsed by almost half. Our theta went down because now we're so far out of the money, and our IV changed by 33.9 points. So if you take a look at the net impact from your delta in Vega, you got a big move in your favor. Your delta gave you 81 cents of profit. And all I did to calculate that was take a linear relationship between these 2 points. It's not perfect, but it's pretty close for an approximation. However, you lost $1.34 from your Vega. So what's your net option P&L? Between Delta and Vega, you lost 53 cents. That's not including what you also lost from Theta. So this is why you have something that literally moves in your favor by 7%. You went out past the earnings expiration because you thought that you would decrease the impact of implied volatility contraction post earnings. You weren't expecting to hold this that long because Theta was that high, and you're still wrong. This is because traders do not focus enough on the changes of implied volatility. And I have a video that talks all about that. We spent a lot of time in the pro workshops working through these exact kind of details because these are the gremlins that really can kill traders even though they have good ideas. These are all things you can learn by poking through options and building up that contextual experience. Be an outlier. See y'all later.